Central banks are rewriting the playbook, just as the AI capex boom accelerates. And that collision is starting to reshape every major asset class. This is vTalkInsight, Allocator's Lens Daily for June 17, 2026. We will look at how a quieter Federal Reserve, a new yield floor emerging from Japan, and a volatile energy backdrop are feeding through to equities, rates, credit, currencies, and commodities. In equities, the dominant theme is an AI-driven earnings boom rubbing up against increasingly demanding valuations. Risk appetite remains strong. AI-related spending is estimated to account for roughly half of recent U.S. GDP growth, and that narrative underpins talk of a tech supercycle. Market breadth has improved meaningfully. Equal weight indices, small caps, industrials, and dividend strategies are registering new highs or double-digit gains, showing that leadership has broadened beyond the mega-cap platforms. Even after the latest session, when the S&P 500 slipped and semiconductor indices sold off sharply, the equal weight S&P continues to outperform, consistent with rotation rather than wholesale de-risking. Valuation markers, however, are flashing. U.S. equity market value is now more than twice the size of the underlying economy, and forward earnings yields sit roughly in line with 10-year treasuries, leaving a thin traditional risk premium. A large share of recent margin expansion comes from AI infrastructure build-out, especially semiconductors, where earnings growth is running in the triple digits and margins have surged in a matter of months. Past cycles suggest that kind of profitability is hard to sustain once capacity and competition catch up. Micro-level signals reinforce that late-cycle feel. Flagship AI companies are incurring very large losses relative to current revenues, yet continue to raise capital on expectations of global scale. Deal-making is accelerating as firms race to lock in data and compute, and newly listed megacaps, such as SpaceX, are experiencing mechanical inflows from index inclusion alongside intense options activity. Concentrated flows, thin free float, and narrative-driven demand can temporarily detach prices from fundamentals and heighten the risk of sharp reversals around lockup expiries or regulatory headlines. For allocators, the opportunity is that broader participation, robust realized earnings, and sector rotation into financials and cyclicals could let equities live with somewhat higher policy rates, especially with oil easing headline inflation. The risk is that equities are effectively underwriting a very benign macro path and flawless execution on AI capex, even as bond and private credit markets sound more cautious. With volatility indices still subdued, shocks around policy communication or AI regulation could have outsized impact, leaving equities as the asset class carrying much of the portfolio growth burden, but also much of the event risk. Turning to rates, the focus is on a potential regime shift at the Fed layered on top of a rising global yield floor. In the U.S., the incoming chair is expected to shorten the post-meeting statement, de-emphasize the dot plot, and lean more on alternative inflation measures, such as trimmed averages that tend to print below headline. Yet core inflation is still near 3%, labor data are firm, and front-end treasuries now reflect the possibility of another hike early next year. Others argue politics and a desire for stability make a long pause more likely. What unites these views is the expectation of less explicit forward guidance and fewer speeches, which would widen the range of plausible path for policy and leave markets more sensitive to each incoming data point. That uncertainty arrives just as Japan is pulling global yields higher. The Bank of Japan has raised rates to around 1%, the highest since the mid-90s, against a backdrop of stronger nominal growth and underlying inflation in the low to mid-twos. Rising Japanese government bond yields are lifting the floor for G10 curves and feeding a broader bear market in developed bonds. Even with the recent slide in oil, curves in the U.S. and Europe remain higher and steeper than before the latest energy shock. Within this higher-for-longer backdrop, some segments are viewed as offering better starting yields, from long-dated treasuries near 5% to parts of the UK gilt curve after front-end repricing. At the same time, money market fund balances stay elevated as few expect policy rates to fall back below 2%. The traditional negative correlation between treasuries and equities has weakened, while core inflation remains above target. For multi-asset portfolios, bonds remain essential but are less dependable as diversifiers and more prone to abrupt repricing when data, energy markets, or central bank language surprise. In credit, the gap between calm public markets and more stressed private lending is widening. At the headline level, bond markets are not flashing distress. Spreads remain contained, and a growing wave of high-grade issuance from large technology and infrastructure firms is lifting the average quality of major investment-grade indices. With starting yields in the mid-4 to around 5%, high-quality bonds are increasingly viewed as a viable alternative to cash, and some flows are edging out of money funds toward longer-dated corporates. Beneath that surface, private credit is showing more strain. Non-accrual rates in business development companies are rising, particularly on loans originated in the 2020 and 2021 Goldilocks period when borrowing costs were low and structures were more generous. Portfolios with concentrated exposures are proving vulnerable, as a single default can meaningfully dent returns now that spreads have compressed. A sizable slice of AI infrastructure has been financed through private credit, and managers are starting to confront redemption pressure and liquidity mismatches. Bank balance sheets are also filling as syndicated lending demand stays strong, especially in the U.S., raising questions about capacity and sector limits. With refinancing walls building toward 2028, weaker borrowers, particularly those tied to AI capex or cyclical sectors, may face a tougher rollover environment just as private appetite cools. For allocators, the message from credit is less about an imminent wave of defaults and more about rising dispersion, where benchmark indices can look stable even as stress builds in specific pockets of the capital structure. In foreign exchange, policy divergence and energy exposure are back in focus, with the yen at the center. The Bank of Japan has lifted rates to their highest levels since the mid-90s, but policy is still well below most estimates of neutral, and markets remain unconvinced that a faster hiking cycle is coming. Dollar-yen sits above 160, and many participants are keen to short the currency whenever BOJ rhetoric sounds cautious. At the same time, there is constant watch for potential Ministry of Finance intervention if depreciation accelerates, turning what was once a one-way funding trade into a two-sided risk. On the dollar side, some forecasters now doubt the Fed will deliver further hikes this year, citing political sensitivities and a possible shift toward alternative inflation indicators under new leadership. That could gradually weigh on the dollar if confirmed, especially against countries where yields are rising. Crypto adds another layer. Bitcoin's current cycle has seen a smaller drawdown than previous episodes, helped by institutional and retail exchange-traded fund inflows, and many expect the next recovery phase to begin in late 2026 into early 2027 ahead of the next halving. For allocators, this mix argues for treating FX and crypto less as one-way trades and more as barometers of how markets are digesting shifts in global policy regimes and risk appetite. Commodities are being driven by a sharp but uneasy repricing in energy. Brent and WTI have dropped steeply, recently falling around 4 to 5% in a single day as a U.S. brokered agreement to reopen the Strait of Hormuz has taken some geopolitical premium out of prices. Physical and financial players are destocking, open interest is declining, and major banks are cutting forecasts. This is now the longest oil decline of the year, easing headline inflation fears, lowering perceived odds of additional Fed hikes, and helping to support the recent risk-on tone in equities. Medium term, however, the setup remains tight. Even after the sell-off, crude is still more than 20% above pre-conflict averages. U.S. strategic reserves are at multi-decade lows, and both Washington and Beijing are expected to rebuild stocks, creating a price floor. Qatar aims to restore liquefied natural gas exports to about 80% of capacity within 2 months once shipping lanes reopen, but the remaining production may take years, leaving a structural gap in global gas supply and keeping shipping insurance premia elevated. Outside oil and gas, gold stands out. Survey data show nearly half of central banks intending to increase reserves, underscoring a multi-year shift away from traditional reserve assets. Gold has extended its rally as falling oil and moderating inflation expectations revive safe haven demand. For cross-asset allocators, commodities therefore offer short-term disinflationary relief, but also a persistent energy and geopolitical risk premium and a strategic bid for hard assets that tie back into the higher-for-longer story in rates. Stepping back across assets, the picture is one of powerful thematic forces meeting a less forgiving macro backdrop. Equities are still doing the heavy lifting thanks to AI-related earnings and improving breadth, but valuations, concentration, and issuance dynamics leave limited room for error. Rates are moving toward less guidance and a higher global yield floor, reducing the diversification benefit of duration. Credit looks benign at the index level, yet more fragile beneath the surface, particularly in private structures tied to AI and cyclical borrowers. In FX and commodities, policy divergence, Japan's reemergence as a yield story, and a fragile energy truce around the Strait of Hormuz are likely to drive the next leg of cross-asset volatility. The key watch points for allocators are Fed communication under new leadership, the sustainability of hyperscaler capex, signs of strain in private credit and bank balance sheets, and whether recent energy relief proves durable. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.